Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Dan Rohinton, Portfolio Manager at IA Global Asset Management. He'll be joining for the hour. In 30 minutes, we'll get the latest read on the U.S. GDP numbers. We'll chat about the U.S. economy and S&P 500 earnings with Drew Pettit, Director of U.S. Equity Strategy at Citi Research. And of course, we want to hear from you this morning on First Call. Reach out with your questions on global large caps, and we'll have Dan answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Well, banks saw better than expected second quarter results, helped by growth across its major businesses and lower than expected loan loss provisions. Net income rose 26% from a year earlier. RBC also raised its quarterly dividend and announced plans to buy back up to 45 million shares. TD posted second quarter earnings that beat analysts' expectations as the bank pointed to improving momentum in its U.S. operations. Total net income reached more than $4 billion. The bank also increased its quarterly dividend, TD highlighting progress in strengthening its anti-money laundering controls following recent regulatory scrutiny in the U.S. CIBC topped analysts' expectations in the second quarter, driven by higher trading revenue and growth across its businesses. Market volatility boosted trading activity in both equities and fixed income. The bank also says it will sell its Caribbean division to NT Butterfield and Son for $1.6 billion US. Unlike RBC and TD, CIBC did not raise its dividend. And that pretty much is our top line story. Canada's biggest banks closing out the quarter with stronger than expected results as market volatility boosts trading and wealth businesses. TD beat estimates with strong wealth and capital markets performance. CIBC and Royal Bank also top forecast driven by trading gains and solid results across their businesses. For more on this, let's bring in our guest for the hour, Dan Rohinton, Portfolio Manager at IA Global Asset Management. Dan, always a pleasure. I haven't seen you in a while. Good to see you back.
It's been a minute. Good to see you.
Yeah, it's been more than a minute. We can't have that happen again. Okay, the banks, they're all in. Everything is rosy and glorious, and Canada is strong and safe.
About as good of a set of results as you can expect in terms of what we've seen over the last. And you know, when you think about what the reaction to the earnings we just saw is going to be, my hunch, Roger, is probably not too much. Yeah. The conference calls are going on right now, so we'll see if some magic pixie dust shows up there. But when you think about what's priced in, this is largely a priced in result. And when you think about the actual fundamentals of what we did see, let's start with RBC first. Mm-hmm. RBC basically put up growth at scale, and that's probably the best way to summarize it. It's the biggest, most diversified bank in Canada, biggest fee mix, and they put up about 14% revenue growth and pretty strong operating leverage, which is relatively hard to do when you're already at the profitability levels or what's known as the low efficiency ratio that RBC is already at. And the buyback is just, don't get too blown away by the 45 billion. It's about 3% of the share count. So it just speaks to the payout ratio overall of about 65% or so. So great, solid, robust results by RBC. The only problem is now you're already at 16 times earnings. Which,
where do you go?
Where do you go from here?
Yeah.
So when you traded NVIDIA's multiple, you probably have to wonder what more the bank can do. But otherwise, clean and pristine.
Any concerns? I'm just looking, there was a 5% in net income quarter over quarter. Insurance segment underperformed a little bit. Any major concerns on?
Not material. Honestly, the best way to think about it is when you think about the Canadian banks, when you should get nervous is when credit questions show up in a major way, or a minor way on their way to a bigger way. Everything else, the banks can really earn their way through without it becoming anything material. So, and I will say what was unique about RBC's quarter relative to some of the others was their actual provisions remain at a pretty low level. Mm-hmm. And they didn't actually, they were the only one that truly materially dropped on a year-over-year basis. So it was by a few $100 million. But I would say where we are today is about as good as we can get on credit quality. It has one of the lowest
provisions. I'm just looking at its numbers. It has one of the lowest provisions, too.
And there's a bit of, call it inside baseball that we need to get into with that. They're also more of a secured book than some of the other peers. So if you're more international banking like Scotiabank is, that's about a provision for credit loss ratio of 66 basis points or 0.66%. That is primarily because of their Mexican operations and some of their South American operations. RBC really doesn't have too much of that. So it's secured. It doesn't have a lot of credit card. So it really mathematically doesn't lend itself to high provision ratios.
All right, let's take a look at TD.
Yeah, for TD, it's really just always a reminder to myself of Canada's such a more profitable franchise for TD than their U.S. entity is. Yeah. And really what TD is trying to work through the anti-money laundering steps and trying to basically reset the U.S. operation on the path to success. I think we saw most of that here. If you had to see, say, the Canadian division, you might as well do a copy and paste of what RBC printed. I think it was 5% year-over-year revenue growth, a little bit of some decent operating leverage in the Canadian business, 25 to 28% ROE. So Canada's been chugging along just fine. I will say TD has more credit cards and more auto lending than RBC does. So their provisions for credit losses actually came in better relative to their the credit quality that they sit overall on a weighted average basis. That's a lot of jargon to say their loans are a little riskier, so they should put aside a little bit more dough, and they mostly got away with doing just fine with high profitability. And in the U.S., Roger, the main thing is that the direction of travel of the...
So I was going to say, does it feel like they're out of the woods there?
They're getting there. And that's why I would say, once again, all the bank earnings are broadly priced in, I would say. Don't expect too much. And TD is the same, the return to profitability and 10% ROEs on the U.S. franchise. We mostly got that this quarter, but with the stock almost up 75% in the last year, you could say investors got well ahead of that.
All right, CBC. Oops, Freudian slip there. CIBC. Your thoughts on that?
Yeah, CIBC. It's so the Korean banking franchise. Think of it as a not really a big part of the overall entity. It always tends to Central and South America tend to create some problems here and there for the Canadian banks. So I don't mind that they sold it. Overall, I think the bigger story for CIBC is this is one of many quarters where they've put together a very strong, resilient set of consistent results. And the running joke back in the day with CIBC was it was always the meme stock, where they would always find a rake and step on it. I think it's important to understand that is a very different company than the bank we see today, where they put out consistent operating leverage, strong top-line growth. Where I would say to be careful and thoughtful with CIBC is they are far more Canadian-centric, which in almost every environment is a fantastic thing. Just see National Bank and how good that stock's done over time because it's been a pure play Canada. What that does mean, though, because CIBC is more mortgage, which is more in Ontario, which is more in British Columbia, they are more exposed to the whims of the Canadian consumer credit cycle than some of the other banks would be.
Yeah, I was just going to say their elevated provisions for credit losses, right?
Yeah, but once again, these are all bottom of the barrel numbers. There's actually all the banks have been basically releasing reserves. But this is the thing you always have to think about with CIBC is mortgages in Ontario, customers in Ontario, customers in British Columbia. They tend to be more leveraged than other parts of the country, and that is where
spend more too.
And spend more. And that is the one thing you always have to think about. But in terms of management, how they're executing, and the focus, give them 5 out of 5 stars.
All right. And then just a quick from yesterday, what we saw, BMO, National, Scotia.
Yeah, I think National was the most disappointing of the bunch. And that's largely a function of capital markets already being very high and then basically running off some assets across the Canadian Western Bank acquisition they did. So it looks like their growth is a little bit slower as they're digesting that relatively large transaction. BMO had the odd credit conversation here. And what actually surprised me about the BMO call and the National call a little bit was credit conversations at a time when credit so far has been very strong and more or less pristine. And new bad loan formations have actually been pretty low as well. So there was a weird conversation about credit in a way that I didn't expect. But overall, fundamentals across all of these banks have been very robust. And that's why they trade at effectively 25-year highs on valuation. So now you have to ask yourself, Roger, what is next from here? And I struggle to see, honestly, what they could really do beyond a little bit more on the buyback and the payout side. But that's very incremental from here.
All right, we got to wrap it up on that note there. But up next, we'll take a look at the markets before the bell, and we'll discuss how gold and oil are reacting to geopolitical tensions in the Middle East. All right, let's see how things are shaping up on the markets, and we will start with U.S. futures. Could be ending a streak here. They even managed to eke out a win yesterday, but right now they are off. You can see the Nasdaq down by 0.33, and the S&P 500 off by 0.22%. In Asia, a little mixed bag, but some strong reaction. The Nikkei down by half point roughly, and the Hang Seng off by 1.25. CSI 300 down by 0.12, almost a wash there. And off to Europe now, and similar situation. You see this, and most of this reaction is to what's unfolding in the Middle East. More shots fired. People not sure how well the peace talks are going. FTSE's off by more than a point. CAC Caral and the German DAX both off by about 0.55. TSX yesterday, still well above 34,000, below record highs, but took a hit yesterday, off by 0.7%. The big ones, materials and energy. Materials down by 2.2, and the energy index off by 1.77. Some of the movers and shakers yesterday. Go Easy, which has been on a roller coaster, up by 6.4. West Fraser Timber up by 4.4. Enerflex going the other way, down by 6.2, and G Mining off by 7.1%. And oil yesterday, it was on its way down, off by 5.25 for Western Canadian Select at 71.61. But today, it's going to be a different story. Yeah, oil on the rise right now, and that is because everything that's unfolding in the Middle East. You can see WTI for July up 2.72% right now, and that is on the news that fresh attacks on the Strait of Hormuz, Iran launching drones, launching a cruise missile, and the U.S. shooting them down, saying it was defensive moves, but this has everybody getting worried again. And gold also falling to a 2-month low, and based on the stronger dollar, worries about what is happening, also worries about inflation, interest rates, reduced demand. Gold's off down to 40, almost 4,400. So it's been dropping for the last few days. So what should investors do with all this? Let's bring in Dan Rohinton from IA Global Asset Management. And Dan, it's you want to say turbulent, but at the same time, the markets don't seem overly concerned. But oil and gold, it's a little more turbulent.
Yeah, and it's important to really just break down where the conversation is being had, right? So when you think about the overall stock market, you know, the U.S. market is over 50% technology. Mm-hmm. So what happens in AI is far more important for many parts of the global stock market, and especially the U.S. stock market, than whatever happens in the Middle East. But if you're in Canada, where energy and gold is everything, well, not quite everything, but it's a big chunk. Yeah, it's 40% of the market, yeah, as a rough rounding. Then the yin and yang that happens between these two types of commodities has a far more profound effect. So in the global stock market, I'm not surprised, because the direction of travel of AI will be the driving force. But when it comes to the Canadian stock market, whether you decide to own more gold or own more energy, fundamentally comes down to how long you think this is going to last. This is way oversimplifying, Roger, but I think it's important to start with the broad generalizations. So higher oil equals more inflation, as energy has a lot of diffuse effects throughout the economy. So whether it shows up,
it's good for the economy in some ways, but bad for the economy in a lot of ways.
Yeah, for most countries around the world, it's
for us, though, for us.
Somewhat.
Yeah,
I'll take the more neutral stance on that.
Yeah.
It's a bit of yin and yang. But for oil equities, it's great because you get higher prices. That's good across about a half the TSX for that, yep, or 20% of the TSX for that. But if you're in India, if you're in Indonesia or China, you know, that's a lot of demand destruction and a lot of loss of purchasing power. So oil higher equals higher feedstock costs, which go across the global economy. And that tends to mean inflation tends to be stickier and moving higher. Mm-hmm. And the longer a blockade goes on both sides between Iran and the United States, the less oil flows through the Strait of Hormuz. That tends to mean inflation equals higher interest rates generally, which means, you know, gold, which doesn't have a real yield, has its real yield is zero. Mm-hmm. It's just to offset debasement in theory. It's less attractive because there's alternative sources like government bonds that could offer you that type of return.
Which we're starting to see people move to a little bit now.
So that's
they're
why
moving up too.
Yeah, that's why don't expect gold and oil to rally at the same time. Expect them to trade against each other. Yeah. And it kind of sloshes around in the Canadian market in that type of way, where we're equal parts gold and oil in that way.
And so what do you do? I mean, do you just sit Or, I mean, because if you're going to try to chase, you're going to be chasing a lot of things at this point.
Well, I think there's two ways to approach it. What's the upside if one scenario plays out versus the other? Because we're in the tail of the distribution in terms of we're in the kabuki theater with negotiations where both sides are going to try to, reformulate their position in a way that sounds palatable, but realistically, they haven't really moved all that far. So the longer the strait gets blockaded, the more demand destruction needs to happen, and the higher oil prices need to go. So what's the upside to oil equities in that scenario versus if the strait is open tomorrow, what's the upside to gold?
Yeah.
I think there's more convexity to the oil trade than there is to gold. So I'm more in the chances of oil prices going higher or staying longer at the current range creates more upside for Canadian natural resources than it does for, say, higher gold for an Agnico Eagle.
Yeah.
So I stand on the energy side because I do think that this is likely to have more prolonged effects than not. And I wouldn't have said that in the early days of this conflict, but there's a attempt to really, on the Iran side, really string this along for as long as possible. And that creates these types of dynamics.
Which could possibly hurt them long run, I guess, if people look at Canada and do take it as a serious source. And now I think we feels like we have a government that is leaning definitely more towards business for this, and oil is one of our businesses, and it's going to happen. Has this crisis been enough to drive people towards Canada and stay interested in Canada?
I mean, so I'll take two sides of that. First side is, I hope so. And
lovely.
Depends how fast that pipeline's built.
Yeah.
Right. So, how much offtake you have, and at the speed at which you do it. It's not like C&Q or Tourmaline can't basically drill more wells faster. That's lightning quick. Building the pipeline, building the export facilities that get you to the global markets could take significantly longer. And right now, the U.S. is doing it faster than we are, and that's just objectively true. The second point of that is, and to your point of, is the Strait of Hormuz less important on a go-forward basis because of the diversification that every buyer of oil around the world is going to look at? I think so, but I think it's also important to understand that we are putting in a lot of electrons and a lot of other alternative energy sources today that didn't have the scale in the past.
Yeah.
So there's a real conversation to be had of, is this the last true supply shock cycle that oil will have? And I think there's a chance of that too.
Okay. Wow, going big. Okay, we got to end it on that note there. But
Sure.
that could go on for a while, that conversation. Okay, we'll be back with Dan Rohinton to see why NVIDIA is on his radar. Time to see what's on the radar for Dan Rohinton, portfolio manager at IA Global Asset Management. NVIDIA is showing up. Is it almost the perfect stock right now?
When you think about the cheapest semiconductor stock with some of the fastest growth rates, and actually a payout ratio that rivals most of the Canadian banks, because they're buying back somewhere to the tune of $80 billion plus, it's a pretty compelling opportunity in my mind. And when you think about what NVIDIA brings to the conversation, it is your diversified way of participating in AI. Because they sell not just the chip anymore, the GPU, the graphics processing unit, but they actually sell the full system. That includes basically fast inference chips, which is Grok, and then they have the networking, and they have the full racks that they sell across not just the big hyperscalers, the big cloud computing companies as they're known, but also the long tail of the neo clouds, and actually the US government, and most foreign governments that are allowed. And that's that participation. So if you want a toll road at a reasonable valuation today, it's actually a wonder that NVIDIA is this low, because it has actually some of the fastest growth rates across the whole semiconductor index as well.
And are there any challenges to it, or any even on the horizon?
The law of large numbers, when you're selling basically $400, $500 billion worth of equipment, there's a chance your customers say, you know what, we'll take a break for a quarter.
Yeah.
Or, we've got a little bit too much, we'll stop for a year or two. So NVIDIA, along with, I would say, what's unique about NVIDIA is their problems aren't unique. It's just that it's so bigger and emblematic of the AI trade that the risk you run with this company is AI doesn't adopt as fast as you hope, as investors hope. So it just goes a little bit slower, takes a few quarters longer, and then you start basically flattening out your growth rate. I would say that is a risk I'm happy to take at this stage And I think the payout ratio is actually increasing. So I think it's a great setup, but the risk you run is push out, slow down, and AI economics that don't really show up in the way that investors hope. But that's a market problem along with NVIDIA's problem.
And could it be a problem if actually AI gets adopted too quickly too, and everybody goes, this is amazing, and they can't keep up?
Well, you know what's interesting?
Backlogs are a good thing to a degree.
They already can't keep up. So what's unique about right now is the bottlenecks are so acute that, take memory stocks as an example. They used to be able to sell their RAM for basically a 20% markup gross profit, Roger. I think Walmart does better than that in terms of their gross margins. Now their gross margins are 80%. So we are seeing bottlenecks explode all across the semiconductor industry, including the physical industrial side, where power and interconnects and basically the cabling is tight as well. So we're going as fast as possible with shortages running from transformers to networking chips.
All right, I want to get in a couple others here. JP Morgan, what do you like about it?
What I think is interesting about JP Morgan is the conversation that Jamie Dimon is having and the lens with which it offers with some of the Canadian banks that we talked about a bit earlier. JP Morgan actually just said yesterday that they're over-earning a little bit. And that's not, and normally...
what head of a bank says that?
Jamie Dimon. Jamie Dimon, maybe he's a Freudian slip or maybe a little bit too much honesty on a consistent basis, but I think he's got a point.
Yeah.
And when you think about the conditions for U.S. banking today, along with Canadian banking, but we'll focus on JP Morgan, they're about as benign as you can go. Strong economic growth, real wage growth, if you wanted to, depending on how you wanted to slice the data, and very benign credit losses. So if you're a bank, you love that. You're surfing the curve, the yield curve that is. Mm-hmm. You're seeing loan growth, and you have capital return. And JP Morgan telling you that, things seem a little too good, gives you a moment to say, I wonder what he's seeing in the background, because the mean reversion might be a little bit, it might lead to some revisions in earnings that are a bit more negative. So I think it does tell you that, we're about as good as we can get across a whole swath of the global banking market.
All right, we're going to get one more in here. EQB, another bank.
Yeah. There's one specific thing that stuck out that my colleague Lucas actually brought to my attention last night, was their personal their personal delinquencies, 30 to 89 days. So we call that early funnel. Mm-hmm. Late funnel is 120 days and you still haven't paid. So 30 to 89 days, we actually saw a pickup in EQB. Okay. And think of EQB as a digital native bank, so more call it younger customers establishing themselves in their life, and a heavy footprint in the Ontario market. So like I said with you, was for the rest of the Canadian banks, we really didn't see all that much and it was bouncing around the bottom. The only one that really did stick out a little bit to me was EQB's early stage delinquencies picking up. So I think it gives you a bit of a canary in the coal mine, because Go Easy is a little bit too far out the spectrum, where if you're paying to rent your lamp and your stove and your fridge, it's probably too far in the subprime to draw broader inference. But EQB is more of a millennial, more of a mainstream bank. Right. And we did see some delinquencies there. Okay, got to wrap it up there, because coming up, we're breaking data on the U.S. GDP with our next guest, and our phone lines will open soon for our first call segment. Call us at 1-855-326-6266 or send us an email, firstcall@bellmedia.ca. We have breaking economic news for you now. We are just getting in at the GDP figures from the U.S. first quarter data. And joining us now to discuss this more, let's talk about the numbers. The first one we have is 1.6% for GDP annualized quarter over quarter. The survey was 2%. So joining us now to talk a little bit more about these numbers, Drew Pettit, Director of U.S. Equity Strategy at Citi Research. Drew, thanks very much for coming into the studio. Appreciate it. Joining Dan and I today. 1.6, survey was 2%. In line, a little lower than expected?
Yeah, a little lower than we expected. It's funny. I heard this when you were talking about this at the beginning of the show. Everyone wants to translate this right to what this means for the market. And you said about half the S&P is tech. We think over half of it is AI when you start thinking about the industrials. So market impact directly, pretty low to us. Mm-hmm. But when you start thinking about areas like the consumer, I would definitely say the consumer. That's where you get a little bit of concern. And this is why, to us, you probably stay in a little bit more of a narrow market range where we're focused on secular growth, tech, AI, for example, and stuff like small cap probably continues to underperform when you have, macro readouts that look like this.
What might have dragged it down?
It's the consumer. It's a little bit of spending power. It's kind of the traditional side of the economy. AI investment, infrastructure build out probably drove most of the growth. If you take that out, you're probably looking at real GDP growth that's flat or negative in the US.
What's interesting about that conversation too is just the big release of the balance sheets of the big FANG stocks, the Googles, the Metas of the world. I wonder how much runway there is to go beyond what they've already done, because they've basically spent most of their free cash flow at this point. So that impulse of growth from here, I'd be curious what you think there.
What you're starting to see in the hyperscalers generally is the cash ROI is leveling out. So I think there is runway. While they're spending a lot of their free cash flow, there's ways for them to get more cash. They actually have good returns on cash in their underlying businesses. Yeah. And the concern kind of in the CapEx numbers is the volume they're getting for the dollars. We always talk about dollars when it comes to CapEx, but when memory prices go way up, when server racks, building infrastructure, that goes way up, for every dollar they spend, they're not getting more compute. But now that you're seeing leveling out in cash ROIs, you feel a little bit more comfortable. And I think that's why you're seeing like the hyperscaler trades start to come back as of late.
Yeah, that's true.
And I'm just trying to pull up some of the numbers as we're looking at them. Real final sales to private domestic purchasers was increased 2.4%. Real gross domestic income increased 0.9%. Some of the numbers, what do they tell you when you hear those numbers?
You're hoping you get maybe a better outlook into the back half of the year for the consumer. Again, like it's funny, like it's all backward looking, right?
Yeah.
And what's the concern today? It's oil prices and inflation.
Forward looking, yeah.
Yeah. So to us, probably expected. Q1 numbers for the like retailers and consumer, not really that bad.
Fine.
No, like let's be honest with you, no one really misses a whole lot when you think about U.S. earnings. It's how much you beat by. But the market right now is looking for, are you raising? Yeah. And when you think about consumer and traditional cyclicals, they beat in Q1 and then they implicitly lowered their numbers for Q2, 3, and 4. So the forward looking, backward looking, okay, we get that. But the forward looking, is this sustainable? Questionable to us.
So what will you be looking for then going forward?
So it's growth. We talk a lot about the NASDAQ still looks really attractive to us. And everyone says, oh, that's the easy trade, isn't it? Because it's worked. I would say it's getting more and more uneasy because it's worked so much. So instead of thinking about traditional valuations, because we're in a completely different growth regime, it's disconnected from macros. Mm-hmm. We think about what's priced in, and we think the market is pricing in 5-year growth of, let's call it 17% for the NASDAQ. The street consensus is modeling in 18. You can still buy that. You can buy high valuations if growth comes through and you have upward revisions. So to us, growth, pricing power, when any company can expand margins, and efficiency improvement where you're starting to see sales grow faster than assets.
How do you think about the concentration in the U.S. equity market? I personally don't think it's a problem, so it's a bit of a leading question. But how do you think about just the big companies already scaling at such huge levels, and as the returns on the capex do flow through, that implies a lot more crowding out of the rest of the economy as a whole?
Yeah, this is, to me, interesting because all of your U.S. portfolio managers now have to deal with stuff, I would say, your emerging market and single country managers have dealt with forever.
Or Canadian portfolio managers.
Yeah,
with the Canadian
completely.
banks, yeah.
So concentration, it's a new thing in the U.S., but it's never freaked us out because you sit there and go, this happens in other markets.
Yeah.
You do have to kind of change your toolkit. And from a strategist seat, this is why we don't sit there. And please, kick me off the show if I ever do this. 20 years of history between rates and the S&P and economic growth and this. I'm like, that's what it means for the S&P 500. No, it doesn't. Throw that all out. You got to look at the market a little bit more bottom up. You have to have a view on the bigger names, but concentration in and of itself isn't bad if you're comfortable with those big stocks in the market.
Yeah, and we had started at the end of last year. We hadn't started to see a rotation away a little bit from it, and all of a sudden it's all come back to it. Is it going to continue that way? Are there any reasons to look elsewhere right now?
Not until you get some clarity on inflation and interest rates. When we talk about the broadening trade, like we do like diversified types of risk, but to have real conviction in it more than like a tactical bounce. So let's say U.S. small cap. Again, I keep coming back to saying like consumer traditional like cyclicals. It's not an either or. You need good growth and rates down. You need both. And it's hard to get conviction in the rates down and good growth happening. You're already looking at the market pricing in a hike for the Fed this year. And even if they do cut, you kind of get worried about how sticky the 10-year is because the Fed doesn't completely control that. On the growth side, you still feel good about the cash returns. You actually feel better about the cash returns versus 6 months ago. And then the back end infrastructure side, they have great pricing power and they're continuing to beat and raise. So we're happy to stay there. I wouldn't say just buy price momentum that has really good earnings momentum and we're comfortable being there.
All right, Dan, I'll give you a last question.
Yeah, what I think is interesting about that, fully agree on that. What I think is interesting is the higher long end and the impact on the housing market and repair, remodel, housing velocity. How do you think about the role that the AI pull is driving on the long end, which is then filtering into the conventional housing market, which has historically been a huge source of jobs and economic confidence?
This is interesting because we talked about AI and productivity enhancements. And productivity enhancements should be okay for inflation, but the short run, it's pushing prices up. So short run, it's a negative. When you actually look at the long end staying high, it's not because real rates or what they think the Fed's going to do longer term is more restrictive. It's all inflation expectations. So that's what's moved up. So AI is now affecting the short run inflation expectations because of the prices that go into chips, into your phone, into your car, into even your coffee makers are pretty smart today.
Yeah. Mine's not so smart, but.
Well, my wife calls me the coffee maker, so she probably says the same thing.
All right, Drew, we've got to wrap it up there, but thanks very much for joining us today.
Yeah, thanks for having me.
We appreciate it. Drew Pettit is a director of U.S. Equity Strategy at Citi Research. Now, some of the stories we're following for you this morning. Royal Bank saw better than expected second quarter results helped by growth across its major businesses and lower than expected loan loss provisions. Net income rose 26% from a year earlier. RBC also raised its quarterly dividend and announced plans to buy back up to 45 million shares. Dollar Tree shares are trading higher in the pre-market after the company beat profit expectations in its latest quarter. Comparable sales rose by 3.5% as the discount chain offered higher-priced items in an effort to attract a wealthier clientele. The company is also raising its full-year profit forecast. TD Bank posted second quarter earnings that beat analysts' expectations as the bank pointed to improving momentum in its U.S. operations. Total net income reached more than $4 billion. The bank also increased its quarterly dividend. TD highlighted progress in strengthening its anti-money laundering controls following recent regulatory scrutiny in the U.S. Still ahead, Snowflake shares are surging after raising guidance and striking a $6 billion deal with Amazon. We'll dig into that. And our phone lines are open. Dan Rohinton is taking your questions on global large caps. Call us at 1-855-326-6266. You can also email us first call at bellmedia.ca. Snowflake shares are jumping in the pre-market after the company raised its outlook and struck a $6 billion deal U.S. with Amazon Web Services. Here to break it all down for us is Bloomberg Intelligence's Mandeep Singh. Mandeep, thanks very much for joining us.
Sure.
All right, let's talk about its outlook first. What's driving that?
Well, I think for a while the concern was Snowflake
may get disintermediated by the LLM providers because they can help you do all sorts of things in terms of building a dashboard without having to need someone like Snowflake. I think what they showed yesterday is they've released their own coding agent. And, for all the data that Snowflake has in their warehouse offering, you can use the coding agent to build, new functionality using LLMs on top of that. And I think that's what drove the upside in the quarter, as well as the guide for the full year was raised by almost 500 basis points because of that trend.
Yeah, those are some pretty ambitious numbers. Is it reasonable?
It is. Look, we know there is a massive spend going on when it comes to AI tokens. And, the question was, can that token monetization happen on Snowflake's platform? And it sounds like, at least for the data that resides in their product, we do think Snowflake will be a beneficiary. And so that guide seems to be prudent.
All right. And what kind of an impact does this $6 billion deal have with AWS?
So, look, the AI products right now are dilutive to gross margins for a company like Snowflake. And what they're looking to do is to offset that with this, $6 billion deal with Amazon, where they can buy cheaper compute, at the same time partner closely with Amazon in terms of deploying their product on Amazon AWS specifically compared to the other hyperscalers. And Amazon will be the provider of, CPU compute to Snowflake, which is, I think, a good partnership in terms of making sure they cost optimize on other fronts, given the dilutive nature of their AI product.
And so overall, it sounds like AI is becoming a bit of a tailwind for Snowflake.
I think there will certainly be a reset of the narrative that was there for a while. And I think they clearly have put themselves in a better position in terms of monetizing AI on their platform. And that certainly could help the valuation multiple as well.
All right, Mandeep, thank you very much for that update. Appreciate it.
Sure.
Bloomberg's Intelligence's Mandeep Singh. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including new coverage on Hammond Power. Let's take a look at some of the notable analyst calls and recommendations. JP Morgan has initiated coverage on Hammond Power with an overweight rating. The firm says the bullish outlook is supported by high demand for custom equipment for AI data centers and clean energy grids, along with increased manufacturing capacity, allowing the company to sustain strong revenue growth. UBS has initiated coverage on Lundin Gold with a buy rating and a price target of $103. The rating is driven by a robust cash flow from the Fruta del Norte mine, a debt-free balance sheet, and a strong dividend policy. Oppenheimer has upgraded Quanta Services to an outperform and a price target of $800. The firm saying the positive outlook is supported by secular drivers necessary to support electrification demands, easy for me to say, and AI development, along with unique large infrastructure project capabilities weighted to secular-driven markets, allowing the company to sustain valuation premiums and opportunities for potential margin expansion. Canada's Minister for U.S. Trade, Dominic LeBlanc, will be in Washington next week, only weeks ahead of the July 1st deadline to review the Canada-U.S.-Mexico trade agreement. CTV's Abigail Beeman has the latest.
Canada needs to hold its ground.
The former chief negotiator for the Canada-U.S.-Mexico trade deal told a Senate committee he thinks pressure on the U.S. to come to a resolution will only increase. Steve Verhoeven believes American irritants like supply-managed dairy and provinces banning liquor can be solved long-term, but not as a down payment up front. He calls autos one of the biggest challenges.
The U.S. has been taking a much more aggressive position on cars this time. And I think that this is something that Canada has to push back hard on.
Canada-U.S. Trade Minister Dominic LeBlanc tells CTV News he will head to Washington next week and says Monday he met with U.S. Trade Representative Jamieson Greer for an hour via video, joined by the current chief trade negotiator. LeBlanc feels there's too much attention on Mexico's trade talks relative to Canada. But the U.S. announced it's kicking off a first round of negotiations with Mexico this week, with no mention of Canada.
I'm hearing from contacts in Mexico that things are not going quite as quickly as the U.S. is portraying it.
Other trade experts told senators it's risky for Canada not to be included.
There's a real danger that if Canada is not present, we will just be handed a list of previously negotiated items and we'll be told sign here or don't.
John Weeks was Canada's top negotiator for the original NAFTA and says his team faced something similar on automobile rules of origin.
It was a hard slog to salvage the situation. Canada should seek to be involved in any such technical discussions.
Of course, all this comes against the backdrop of the July 1st deadline for a review of the Canada-U.S.-Mexico free trade deal.
And that was CTV's Abigail Beeman. When we come back, Dan Rohinton takes your questions on First Call. First call and first email. This one's from Jimmy. Dan, the pundits are generally excited about Palantir. Do you have a specific comment and agree there is a mock force thrust behind the growth profile?
Yeah. So
Dan has a comment.
So interesting for Palantir. It's call it deeply embedded enterprise software is probably the best way to generally say it. They have phenomenal growth, phenomenal margins, and phenomenal free cash flow for what they do. So is there a very robust and aggressively successful flywheel? Yes, there is. So I actually do think if you have a very, very high risk tolerance, Roger, I do think it's interesting today because
it's quite the roller coaster there.
Yeah, and if you only look back a few years, it's equally
exciting.
Equally exciting. But the point being is their growth is fast, very fast, legendary in software. Their margins are very high for their stage of growth, and the valuation is now approaching, call it, I believe, memory serves 60 times earnings, 70 times, which you would say is, whoa, take a step.
Yeah.
But for that level of growth, for that level of enterprise software penetration, there's a real chance that this is actually an interesting buying opportunity today, but only for the highest risk portion of your portfolio at most.
At most. And what headwinds could there be? Everything.
Well, you know what's interesting with Palantir is it's not that different for what drove the fears around Snowflake or any of the other companies like Datadog to Salesforce.
AI.
Is AI going to basically abstract away and do the work that their forward deployed engineers would do? And is there a way that they could really lose share to the big AI labs as they crowd out the rest of the enterprise software space? Entirely fair. I would just say you're increasingly starting to get paid for taking the other side of that bet.
Okay, we'll leave it on that note and go to an email from David. Can I have your opinion on Banco Santander? Santander?
Santander. Interesting. So what I would say is you got to ask yourself what you get with Banco Santander, and you get some operations on both sides of the Atlantic, if you will. So South America and Spain. I would say there's far better opportunities to own direct exposure in the European banking sector. Think of your KBCs of the world where they're growing in the Eastern European markets. And you don't need the complexity that Santander offers. So this is a family-run bank from a very long time. I've actually been to their headquarters a few times. It's beautiful. I would just say it's not really the prime expression for lean, mean banking that you want to get.
Yeah.
And
old school. It sounds like a very old school banking.
It is a very old school bank. So I would just say there's probably better European banks out there. So I'd look to an ING. I would look to even like a KBC, or even if you want to go further out to Central Eastern Europe, there's better opportunities there for the same level of growth, if not better.
All right. Let's sneak in an email from Aaron. I would appreciate hearing the guest's opinion on Brookfield Core. It's a difficult company to understand. Is it a solid long-term hold?
Yeah, you and me both. So the dynamic with Brookfield is it's complicated on complicated. So there's different parts to it. Generally speaking, the way to think about it is Brookfield Corp is as close to Bruce Flat as possible, and that's generally where you want to be.
Yeah.
That's my rule for the Brookfield family of companies. What I do think is interesting is there's other private equity companies that have actually seen a lot more pain more recently. So I'm a lot more interested in Blackstone and at Apollo today than I am Brookfield, but I would say you're in the structurally best place to be within the Brookfield family. And if you want to go further down the Brookfield family, Brookfield Renewable has a new lease in terms of demand growth that they have coming their way because all of the power build out that is going on. So they own electrons and the generation of those electrons at a time when everyone is clamoring for it. That provides a little bit more convexity and torque across the Brookfield complex. So BN's a good place to sit, but if you want to step out a little bit more further down, Brookfield Renewable might be interesting as well.
All right, we've got to wrap it up there, Dan, but always a pleasure to have you on. Thank you for joining us, sir. That was Dan Rohinton, portfolio manager at IA Global Asset Management, joining us on the street today. And up next is the Open. Trading gets underway in just over 30 minutes from now.